Well, hello again, and welcome to the Beauty Business Strategies Podcast. Again, Michael Yost here with you, and today, we've got another great guest for you. And this time, we're trying to find people from all types of industry, but still that apply within the beauty industry. And today, we are joined by Tina Azarvand, and she is a tax attorney. And I think this is going to be we met, just to give a little background, we met together at a conference. We happened to be side by side, the strategy booth and her booth side by side. We struck up a really great conversation. And I'm like, man, again, what you do and the things that you deal with are so relevant to our industry in so many ways that we should do a podcast. And as a lot of these things get birthed, and here we are. So Tina, how are you today?
I'm doing well. How are you?
I am good. So I just gave you just a short little brief introduction, just said tax attorney, but just give again the listener just a little bit more, just expand a little bit more about what you do, what your line of work is, scope, things like that.
Sure. So I have my own tax law firm where we have tax attorneys, CPAs, and bookkeepers. And we're 100% focused on tax law for mostly employers, but we also help individuals as well. So we help, employers plan for the future, which is a big thing that people miss. Everyone has a tax preparer, but not everyone has someone planning for their taxes. So we're kind of taking a proactive approach for people, and we help them minimize their tax impact. And we also do, a lot of collection work if you have liabilities with the IRS, or if you're under audit, whether that's a sales tax audit, income tax audit, ERC audits, all types of audits we love. So anything tax law related, really.
I love the fact that you love the word audit, and basically it strikes fear into the hearts of everyone else listening. So it's good to know there are people out there that are like, audit? Cool, I got your back. So that's awesome. That's awesome. So I think maybe the best place to start would be this, is let's start with, from a tax standpoint, let's just start with like foundationally, give us some direction on and give us some clarity around when we're starting up a business, or maybe we even have one now, but the best way to structure our businesses from a business kind of entity standpoint. We're talking about LLC or S-Corp, or, just all the different variations are there. I think a lot of times people just aren't really certain about where they should line themselves up. And typically we just take the advice of what someone else told us. So give us a little bit more depth in that area.
Sure. So there are a lot of benefits and always some drawbacks to each type of classification that you can take. Any business can start as a sole proprietorship. That means you haven't formally established it. You're operating under your Social Security number. So that's how most people start their business, but typically shortly after, people tend to go the LLC route. And then from there, if you're an LLC, you can take an S-Corp election, or also a C-Corp election, which is not very common in this industry whatsoever. And then, of course, there's partnerships as well as just outright corporations. So the most common ones we see in this industry really are LLCs and then S-Corp elections, which, otherwise you would be an LLC. Those are the two most common, and both, have their own benefits and drawbacks. The biggest benefit of an LLC over an S-Corp is that it is much more simple. It's a disregarded entity for income tax purposes. So everything flows through to you. You file your own 1040, and you don't have to go file a completely separate return for that. If you have payroll, you are going to have to file your 941s. But we're just talking about the income tax element, whereas if you have an S-Corp, you have to file an 1120S for your return or for your business on an annual basis. And then in addition to that, there are other requirements that you will have to adhere to. So, the biggest pitfall we really see here is where people don't know the requirement with S-Corps that you have to pay yourself what is considered a reasonable salary. So it looks at the industry standard of what someone would be making in that position, and you have to pay yourself that. So businesses that aren't at the point that they're able to pay themselves a salary as the owner should not be looking into S-Corp status. It would be more ideal. It is always more ideal to be an LLC over a sole proprietorship. The only real benefit I can see of a sole proprietorship over an LLC or any other structure is, it's really easy to start up that way. If you're not going to have employees, you're not, as a sole proprietorship, you're not going to have to file for, under the Corporate Transparency Act, which isn't too much work. That's something that's new and went into effect this year for businesses, where you have to file an annual or not an annual report, but on within the first year of the program going into effect for 2024, everyone has to file. If they started their business this year, then they only have 90 days. But that is something that wouldn't be applicable to sole proprietorships. So, the biggest benefit there is that it's just very simple. There's not additional filings like there's going to be with an LLC or S-Corp. S-Corp will have the most paperwork involved, but it also, has the most benefits. A benefit I really like about S-Corp status is that if you're in a state that has high income tax, or you're also paying more than $10,000 per year in sales tax, there is no cap on the state and local tax deduction. That was capped at $10,000 under the Tax Cuts and Jobs Act of 2017, but that cap of $10,000 does not apply to S-Corps. So if you're paying a lot of taxes through your business, whether that's, and you can also do property tax with income tax, or sales tax with income tax. You can't do all three, but you are able to do that. And that's a really big benefit in terms of S-Corp. That's probably my favorite benefit. There are other tax savings. You're going to be treated as an employee of the business by default under an S-Corp. So, you're not going to be subject to the self-employment tax. You can withhold FICA taxes through the business. And that's another big benefit there. So those are just, some of the highlight points that I like to touch on with S-Corp, LLC, and sole proprietorship. I don't know if you want me to go more in depth. I know there's probably a lot of topics to cover, so I don't want to go on too long.
No, I mean, that's awesome, just to kind of hear again some of the benefits to, because I think a lot of people probably typically think, they probably based it around the fact that, oh, I have to be a certain size in terms of sales, or a certain size in terms of employees, to be able to maybe classify myself in one of these ways outside of sole proprietorship, but either LLC, S-Corp, or anything beyond that. And that really isn't necessarily the case.
Correct. Yeah. So you don't need any employees with an LLC. You don't need to treat yourself as an employee. With an S-Corp, you yourself would need to be treated as an employee, because you're going to need to receive a reasonable salary, but it can just be you as an S-Corp. Okay. So that's a common misconception. I'm glad you brought it up. But yeah, there's no limit on having a minimum number of employees. So it's, awesome. Yeah, it's really, it just comes down to if you can pay yourself a reasonable salary or not. That's really where the determining factor is of if you should be doing an LLC over S-Corp, because generally, other than the fact that there's more filings required for an S-Corp, it's generally always better to be an S-Corp, because there are more tax savings.
Awesome. It's so, that alone, I think, I could end the podcast right here and be in great shape, because you've already, I think, given us things to think about that we might not normally, the way we might not normally view things. So, and I think this also sheds a lot of light on the fact that working with someone like yourself, someone that knows tax law, a tax attorney, the benefits of working with someone like that, typically it seems like probably people call you up. Let's kind of go a little different direction, because I bet you most of your calls come when it becomes like, a red flag has arisen, or I've got a little bit of trouble on my horizon that I can view. And that's probably when your phone starts to ring more or less then, not in the setup to make sure that I'm in good shape. And we'll kind of cover both sides of this, but let's start out from this standpoint. What are some of the pitfalls, before we get into kind of what happens if we get into a little bit more of a negative situation, but what are some of the pitfalls that you most often see that lead us down a road we don't want to go?
Yeah, so that's a good question. The most common pitfalls in this industry, really, number one comes down to, I would say more common than anything, is the penalties that can be involved when you pay taxes late. And a lot of people don't realize that, you're supposed to be paying, when you're self-employed, you have to pay on a quarterly basis. So, if you have an S-Corp, you're having FICA taxes withheld from your W-2. This is not the case. But for anyone who is self-employed, you have to be paying estimated tax payments on a quarterly basis, as I mentioned, and the penalties for failure to do so can cap at 25% of the balance that ends up being due, and that amount is also subject to interest. So a lot of the time people end up nearly doubling what they owe just in penalties and interest, because not only is there the underpayment of estimated tax penalty, which generally is 5% per occurrence, but it accrues and it can go up to 25%, and that's per tax year. There's also a failure to pay penalty. So people, they'll file an extension that from the normal 4/15 due date, they'll be like, okay, I don't have to worry about this until October 15th. But an extension to file is not an extension to pay. So, that's a common issue people don't realize, because they'll have a balance due year after year because they're not making their estimated tax payment, which they're going to get dinged with on that. And then not only that, but they're also going to get hit with the failure to pay penalty, which actually the IRS just changed in the last couple of months, where it did begin to accrue at 0.5%, going up to 1% per month after they send you a notice. And this also caps at 25%. They did just change that to be 5% per month, and it caps at 25%. So let's say you owe $10,000 and you pay that late and you cap out, you now owe $15,000 plus the interest. So you probably owe $17,000 to $19,000. Wow. So depending on when you pay it, but that, it can nearly double what you owe. And then there are other penalties as well that are common in the industry. People do sometimes file their returns late. That's also another maximum penalty of 25% for failure to file. So failure to pay, failure to file, failure to make under or estimated tax payments, and then also failure to deposit your payroll penalties on time. So either employers have to either do it on a bi-weekly or monthly basis of doing FICA tax deposits. Sometimes people don't realize that, and they think, oh, these are my quarterly payments, and they'll pay those on a quarterly basis. But the penalties for failure to pay on time for the tax deposits is 15% maximum. So if you're even 1 day late, the penalty is 2%. And the longer it takes, up to 16 days is how long it takes to get to that 15% cap. But it's just, a snowball effect of, if you start paying late and then every, payment is a little bit late, it's just going to be more and more penalties. And people they're like, I don't even know why I owe this. I owe so much. And they don't see the breakdown of, a lot of the time it's mostly penalties. Sometimes people will have more penalties due than the interest, just because, or penalties with interest due than the tax, just because it's been sitting so long. Now the interest rate for the IRS for underpayments of tax, it's 8% per year. So, it's better to go out and get a mortgage at this point, which even their rates are pretty bad. So that's the most common pitfall we see in the industry, is just people not knowing how the penalties work and how to avoid them. Because, when you go to a tax preparer, most of the time they're only looking at your return to prepare it. They're not proactively planning for you. That's not always the case, but I would say more than half of tax preparers, fail to be like, hey, you're getting hit with a balance due every year because you're not making your estimated tax payments. Here's what can happen. Here are the penalties. All of the penalties are subject to interest, plus the underpayment itself is subject to interest. So they don't do that. And then year after year, they just have a liability that keeps growing and growing and growing. And then eventually they just can't afford to pay it. And that's when you start to have more issues with the IRS. That's typically when we get the call, is they say, hey, we owe. It's not, hey, there are some people who will call and be like, hey, we're planning for this major transaction and we're just trying to be proactive. But that's probably less than 5% of people I talk to. So, the big thing is people just get into the snowball impact because, if you're not a tax professional, you're not expected to know these things really, but they affect everyone and they don't really teach you about them. So that's the most common pitfall. The second most common pitfall, I'd say, is worker misclassification. So misclassifying people as independent contractors instead of employees. So that happens a lot in this industry, but really it comes down to, the main issue is that if you don't withhold the proper taxes on behalf of your employees, the penalties can be super, super severe. So, we already mentioned the failure to pay penalties and all of that, but there are a lot of different other penalties for worker misclassification. So if it was unintentional, it can be it can be 100% of the taxes due plus additional penalties. If it's intentional, they can also incarcerate you for up to 1 year. And there are a lot of different penalties involved, because there will also be possible penalties from the Department of Labor that range from 10,000 to 25,000 per employee. And then it's 100% for both intentional and unintentional. It's 100% of the matching FICA tax, and then 40% of the FICA that wasn't withheld, and then 1.5 through 3% of the wages for failure to withhold if it's intentional and if it's unintentional. So, it just adds up. I can't even give you a total number on that, but it'll more than double.
I was just doing math in my head. I'm like, oh my word, that gets, it's a snowball. I mean, it just starts to really, it keeps gaining momentum the farther it goes. So when you're talking about misclassification, just for clarity on my end, I'm interpreting that as the idea of, we're talking about someone who might say, oh, well, they're a 1099 or independent contractor, right, versus an employee. You don't make that decision as the employer. That's out of our hands. I think a lot of times, and correct me on the areas where I might be on the right track and areas that might be a little bit off. That's why we've got you on the podcast, to get all of us more clarity. I think a lot of times it feels like most employers feel as though, well, they make that decision because this is how they'd like it to be done. And that's just not how it works, is it?
No, yeah. So, there's a bunch of factors the IRS will look at. They're really looking at the behavioral control, financial control, and the relationship of the parties. So, if you're saying, hey, you have to come in tomorrow 10 to 6, that's not someone who's independently working. They're not setting their own hours. If you're providing them the equipment, that's not someone doing it independently, for example. If there's a contract that says, hey, you're an independent contractor and you're responsible for your own equipment, you have to pay a contribution towards use, whatever it may be, that points towards an independent contractor. So there's a ton of different factors to go through. But really, like you said, it's not the employer's determination. You're either an employee or you're an independent contractor. And being familiar with what that test looks like is very important before you classify someone as an independent contractor, because there is a mechanism, it's called a Form SS8, where the worker can just request for the IRS to determine their worker status. And that can happen on the state end as well. So there's a state version of that. So it can happen from either. But at that point, it's very hard to come back from once the IRS audits you for worker classification, because that's when it becomes either was it intentional or unintentional, and what are your penalties going to be based on that, So people don't realize that it's such a big issue, because then they'll have a disgruntled worker that leaves and they're like, you know what, I should have had them withhold my FICA taxes. Now I have a larger tax liability because, obviously as an independent contractor, you're fully liable for your self-employment taxes. So again, they have to make their own quarterly estimated tax payments. And, it's 15.4 or 15.6% total for the tax that they pay. Whereas as an employee, 50% of that is paid by the employer. So it's always better for them to be an employee versus an independent contractor. But for employers, they have incentive to have independent contractors instead of employees, because, there's no overtime, there's no benefits, you're not paying FICA taxes on their behalf. So sometimes people will be like, well, I can get away with it. Nah, no one's going to know, or what's the difference? And they don't realize the snowball effect it can have. The good thing is if people have been misclassifying their workers, there is a voluntary disclosure program through the IRS. So you don't forego all of the penalties, but you can forego most penalties altogether. They're going to want repayment of the taxes and all of that, but then they're not going to be looking at it from the perspective of, you didn't disclose this. If you come to them and say, hey, I'm trying to fix this issue, I didn't know, it's not the end of the world. But I don't ever recommend. People will be like, well, I'll just roll the dice. How are they going to know? They haven't caught me this long. But the IRS is catching up. Their technology is improving quickly. And all it takes is one worker to file that form, and it can literally destroy a business, especially if they find you to be intentional, because like I said, they can literally incarcerate you for up to a year. And the penalties are very, very, very severe. So not to freak anyone out, but it's just.
Well, no, I think it's, listen, I think a little freak out's also a little bit important as part of this, because this is what we want to avoid. So let's kind of continue that conversation a little bit. Is the idea of, let's say you have fallen behind on some taxes. Let's say you're late with some payments. Let's say there's some situations like that going on. As you just mentioned about in that situation, hey, listen, here's what you can do. There's a voluntary way that to help. If we miss classifications, there's ways to kind of make that be not as painful as it possibly could and get right. What about situations where, maybe someone that is listening or something like that is saying, I know I've fallen a little bit behind. I know this. What would some advice that you would give to people that might be in a situation that is a negative situation?
Yeah, so definitely, it's not something you want to bury your head in the sand with, because a lot of people are like, oh, I just want to avoid it. I don't even want to look at the notices. But after a point, procedurally, the IRS can enforce the collection where they can, garnish your wages or any payments coming into your account. They can levy assets. Typically, they go for bank accounts, and you'll discover that after the fact of when they've already done it. You'll go in your bank account and be like, where'd all my money go? They'll send you notices of intent to levy, but they won't tell you when they're going to levy. So it's kind of a gamble there. They can file tax liens. And if you owe over a certain point, it's either around 52 or 62,000 with tax penalties and interest due combined, they can suspend or seize your U.S. passport. So they can literally strand you in the U.S. and make it so you can't travel. So that is a change that's happened in the last 10 years. It wasn't something they could always do, but that's a really powerful enforcement tool they have now. But if you get into what's called a reasonable collection alternative, none of those things minus tax liens will happen as long as you stay compliant. So that's what a lot of people don't realize is the IRS is only scary if you ignore them. Like if you do try to resolve it, even if you can't pay it in full, there are resolutions, So number one, most common that people know about is installment agreements. It's literally a payment plan. You can pay depending on how much you owe. You don't have to submit financials sometimes you do, and then sometimes they'll let you pay it even through the collection statute expiration date, because the IRS, they only have 10 years from the date of assessment to collect the tax, absent, there are some tolling events that can pause that and extend it a little bit. But if they don't collect it within that date, then they have to write it off. So they do have payment plan options that will go through the collection statute expiration date. And then another really good option that, is actually pretty common in this industry is the offer and compromise option. There's 4 different types of offers. One is doubt as to liability. You're coming to the IRS saying, hey, I'm disputing that I actually owe this. Here's the proof I don't owe it. More commonly is the two doubt as to collectability and then doubt as to collectability with special circumstances. Doubt as to collectability is saying, hey, IRS, I can't afford to pay this without suffering a financial hardship. So you're just going based on the fact that it looks at your income versus expenses and the total amount of equity, and they're going to consider things like your ability to produce future income if they enforce the tax, your ability to produce or provide for your health and welfare, all of those things, and then doubt as to collectability with special circumstances is similar, but it's saying, hey, I could pay this tax in full, but it looks like I could pay this tax in full, but I have special circumstances that it's going to create a financial hardship for me if I actually do. So let's say, you have some serious medical conditions, or it's going to cause it so you have to shut your business down, and there goes your ability to produce your income completely, so different circumstances like that. And then the fourth one, which is the least common, it's less than 2% of all offers submitted, is based on effective tax administration. It's saying, I could pay this in full, but I shouldn't have to pay it because of some public policy reason, and facilitating collection of this tax liability will undermine the public's confidence in the tax system. So very, very, very uncommon and very rare. Right. That typically comes out when people have been defrauded, something really bad has happened to them, and it would just kind of be a wrong situation to collect from them, but that's why it's not common at all. And you also have to have the ability to pay in the amount 100%. So there's 4 different types of options, so it's very unique to the taxpayer situation. The two most common in this industry, though, are doubt as to collectability and doubt as to collectability with special circumstances. And then the third route that people can take, but it's only really for if you're insolvent, is currently not collectible status. It's where the IRS will give you a 2-year hold where it doesn't pause the collection statute, but it does pause their enforcement actions. So they'll just send you annual reminders during those 2 years, and then they'll only offset your refunds during that time, but they won't do anything else. They're not going to levy you or anything like that. And then it can be renewed. But, it's kind of a temporary fix to a long-term issue. So that really is only good when businesses are truly insolvent and have a foreseeable future of continuing to be insolvent. So those are the main, ways to resolve issues. Another thing I do want to touch on is penalty abatement. A lot of people don't know there is the option to get penalties abated through the IRS. There are 8 different types of penalties that you can get abated, including the failure to pay, failure to file, failure to deposit your payroll, your FICA tax deposits, and underpayment of estimated tax liabilities. So those are the most common penalties you'll see anyways, and they can be abated under 2 different programs. One is reasonable cause penalty abatement. So you have to show that you took all reasonable steps and care and prudence, but nonetheless were unable to either file your return or to pay the taxes due for some extenuating circumstances. So let's say you got hit by a hurricane, or you had a spouse die, or you had serious medical conditions, or your house burned down, or something that really severely happened. And it doesn't just have to be those things. Those are more common. But it can also be, reliance on bad tax advice is one. That's a little harder, but it is one of the options, and that's not a complete list. I'm just giving some examples, but you can do a written request and submit that to the IRS. It normally takes them about at least 6 to 9 months to respond to that. They are very slow. And then the other option is first-time penalty abatement, which is very little known by most people, but the IRS has like a one-time program where you can, as long as you haven't had penalties in the 3 prior years, you can, and you don't have to have any reasonableness. You can say, you know what, I really wanted to buy a new car last year, so I didn't pay my taxes. And they will still give it to you as long as you haven't accrued penalties in those 3 prior years. But first time abatement, you could just do that over the phone and they'll just do it on the spot. But I don't ever recommend getting penalty abatement until the liability is about paid in full, because the penalties will start to accrue again. And that's what a lot of people don't realize. So you do have to be very strategic in your timing of submitting for penalty abatement. But those are the 2 programs, is first time abatement, which I recommend really think that out of when you want to use it, because like I said, you don't have to have been reasonable. You can save it for, hopefully you never have a situation where you forgot to pay your taxes. But if you did forget to pay your taxes, you could just save it, because that is not reasonable cause. But yeah, those are some of the collection alternatives, just in a nutshell.
I love the fact that you deliver all of this news with a smile on your face, the whole time. Here's what I'm getting out of this as we start to kind of wrap things up here. I think one thing to me is becoming extremely clear is the idea of having someone that's a tax preparer, such as, again, we think about our accountants and things like that, is a much different person than, like we're talking with you, someone that can help you plan, make a plan for what's happening in your company, a plan for taxes, because we don't want to be in these types of situations that we discuss. We don't want to get into this negative situation. So as we wrap up, I'm going to ask you I want to end on a positive note with this. Give me 2 things that you would say, hey, listen, here's what I would advise when it comes to just being proactive in the life of a business owner. What would you say proactively? Let's stay on let's make our lives easy. Let's stay in the good course. What are the 2 things that you would jump out to you?
So, I always recommend people meet with whoever does their tax planning, or get someone to do tax planning, on either a quarterly or semi-annual basis, of just sitting down being like, all right, what are your profits looking like this year? We need a plan for are you going to have a large liability? Is there anything we can do now to reduce that? Whether that's purchasing new equipment, which is under Section 179, which you can immediately depreciate, things like that, of bringing down your liability. Are you missing any tax credits? The work opportunity tax credit, for example, commonly missed. We didn't really talk about it. I won't go into it too much, but that's one that's commonly missed in this industry as well. And just kind of having these either quarterly or semi-annual check-ins of, what your business plan is, what your profits are looking like, where you want to take things, and then just making sure you are on track to have your taxes paid in full before the time the return is actually due, because you don't want to accrue any penalties, because as I think we've all learned, they add up really, really quick. So
yeah, I was going to say, you illustrated that very clearly, but that's awesome. I mean, this is what we need. So Tina, this has been a fantastic, fantastic time with you. Obviously a wealth of information. If someone is listening and they wanted to connect with you and dive in more into their situation and have some questions that are specific to them, what's the best way to get in touch with you?
So they can go to our website or send us an email. So maybe if you want, I can do like a quick screen share with it, and then
what we could do is we can put that in the link in the description.
Perfect.
So we'll definitely do that. So like I said, if you want to connect with Tina, we'll get all of her information. We'll put it in the description, and you'll have that. And if you want to reach out, that's awesome. As we wrap everything up today, any last thing you'd like to share with the listener?
No, I appreciate it. And thank you for doing this information share. I just know spelling my last name isn't always easy, but this has been a pleasure. I hope you guys learned something. And I appreciate your time as well.
No, it's been awesome. I know it's been helpful to me, and I'm sure it's been helpful to everyone else. So thank you, Tina. And thank you to everyone that listened in. We look forward to seeing you on our next podcast. Until then, have a great day.
Thanks again for listening to the Beauty Business Strategies podcast. If you like this episode, be sure to hit follow. To learn more about how strategies can help create more fun, profit, and growth potential for you, your company, and your team, we invite you to schedule a free 60-minute strategy session by clicking the direct link in the description of this episode.